right, welcome back, everybody. I have a very special guest today. In fact, I'm intrigued to talk about some of the issues that we encountered this year. There was a huge case in Baltimore City related to the fraud. It shook the whole industry, specific to DSCR originators and folks that are buying DSCR loans. For folks that don't know what those loans are, I have Jack BeVier with us. He is the partner at Dominion Financial Group. And I heard Jack talking about those issues, and I wanted to bring him on to our podcast to talk about not just the problem and the fraud, but also possible solutions to that. A lot of my clients started to investigate what can we do. They test us, my companies, to define a few products, and I wanted to brainstorm with Jack on whether or not those products will do the trick. So, Jack, welcome to the podcast.
Hey, it's great to be here. Thanks, Alex. I'm looking forward to it.
My pleasure. Well, before we jump into this fraudulent scheme that I'm really interested to hear your perspective about, um, let's touch on DSCR and RTL market, right? Um, it was not there a few years ago, and now it's super popular. So let's can you talk to the audience about what is DSCR? Um, you know, who plays there, and whether it's a small or a large market.
Yeah, sure. So it's DSCR stands for debt service coverage ratio, which is a reference to how the loans are underwritten, which is primarily focused on the rental income from the property, the insurance cost, your property insurance, and property taxes. And so we do a basic PITI calculation, and that's what they that's DSCR combined with the borrower's FICO and the property level loan to value that the borrower is looking for are really the three primary drivers for pricing for those loans and the three primary drivers for underwriting. So that's where the DSCR loan came from, or the term comes from. It was a product that I think it started back in really like 2017 timeframe. Virus kind of was, I think, the first one who was really kind of introduced the product to the market. And back pre-COVID, though, the rates were a lot higher, right? Because it was just another non-QM mortgage product. So wasn't as competitive with the local banks in terms of financing investment properties for aspiring and growing landlords. But when COVID hit and, that turned pricing, that, really ratcheted down pricing, and the DSCR loan became competitive with local banks. And frankly, America's real estate investors haven't looked back. At this point, if you're a real estate investor doing single family 1 to 4 unit property, the product actually goes up to 9 units. But small residential project, um, you might use an RTL loan, a fix and flip loan on the front end to get the property stabilized. But once you put a tenant in there, you refinance into a 30-year fixed rate loan, with rates that are competitive with what you'll get from your local bank or credit union, and with a much faster closing process, much more certainty, and frankly, an easier underwrite. They don't, the product focuses on that particular property as opposed to digging into your tax returns and calculating a global coverage ratio for you as a business, which a bank is going to take that approach. So because of that faster process, more predictable underwriting, uh, and as a result, faster closing timeframes, it's become a very popular product for real estate investors that are growing their rental portfolios.
So really, to qualify for that product, you don't have to have a an income, right? It's all based on the property and valuation of how much of a rental income you can collect, and whether it makes sense for the lender.
Exactly. Yeah.
Okay, that's very interesting. So, and it started, you said, in 2017, it started to be pretty popular. Is that geographical dependent? In other words, if you have a migration to Florida, all the investors are rushing in and trying to fix and flip or create the rental properties there.
Yeah. So the product works best in certain geographies, right? So like California, the ratio of property value to rent, not that attractive from a rental yield perspective, right? So you are always, you're always DSCR constrained in that underrate. Whereas if you go to Ohio, the DSCR is not the issue, and so you'd be capped out at loan to value. But it's because of the lack of the not doing a deep dive, frankly, on like the borrower's tax returns and focusing on the property level economics. Um, it's made it so that it's a lot lower barrier to entry to become a landlord. And the product's offered nationwide. There's no like, it's got the same constraints in terms of the math that you have to solve, so that it lends itself to certain geographies more. Um, but you can use it in California. You can use it in Baltimore City.
Now, talking about the level of interest rate. So, based on what I know, some of the largest Wall Street firms became interested a few years back, not in 2017, right, when the property values were low, and I thought that would make a lot of sense. But now, with the property values are very high, does it still make sense, or it's selective as well?
Yeah, the DSCR ends up being the constraint in terms of how much debt you can put on a property. So those loan to values have come down as property values have come up, has gone up faster than rents have. I would say that it became a very popular product in the 2020 2021 timeframe, obviously just because rates were so low. As rates have increased over the course of the past 4 years, as everyone knows, um, it has still, volumes are actually probably still growing because the DSCR loan product is taking a bigger share of the investment community market. So I think that the pie has grown for DSCR originators at the expense of local banks. I think that the local bank originations have really taken a hit as the DSCR loan product has replaced it. So, despite the fact that it is harder to make the math work today on any given deal, the pie's been getting bigger and bigger. And like you said, the Wall Street demand has been incredibly strong. It is when you look at the performance data for on remittance reports, the DSCR loans are actually performing quite well. So relative to other non-QM products. So since those delinquency rates have been so low, um, and you can get an extra 150 basis points if you're a loan purchaser relative to agency mortgage product with a similar borrower credit profile and a lower loan to value profile, it's become kind of a darling product for securitization, non-QM securitizations, and particularly insurance companies that in the 2023 to early 2025 timeframe really dominated the secondary market. The insurance bid was just the sharpest. I'd say that since the beginning of 2025, the market has evened out, and the securitization bid is now on par with the insurance company bid. But there's still a lot of institutional demand.
Interesting. So really, to qualify for the mortgage, DSCR mortgage, I would need to open a company, let's say Alex LLC. I will knock at Jack's door and say, Jack, I need a loan for this property, which is valued at, let's say, $1 million, in the neck of the woods that you probably know because you graduate of Wharton School of Business, right? So let's say that on the Market Street, right outside of the Market Street in Philly, I'm buying this property and I think that the value is $1 million and the rental is X, right? Let's say $10,000 a month. Um, what is the typical underwriting technique to give me that loan? Am I qualified? Do you actually, what do you check for? And let's get from that to the actual story on what happened in Baltimore City.
Yeah, sure. So they're going to do an appraisal of that property to validate that price or that valuation. They're going to look at that lease, that $10,000 a month lease. They're also going to ask the appraiser to do a 1007, which is a market rent determination, to validate that they agree that 10,000 is the market rent that you have. They'll look at that lease to make sure it's arm's length. They'll pull the property taxes. They'll ask you for your insurance bill, and they'll do a PITI calculation based off of a 30-year amortization. And then depending on and then they'll take that, they'll say, hey, what's your desired leverage? By the way, given the profile of this property, the debt service coverage is like 1.1, let's say, at 60% loan to value. It'll be something in that ballpark. and they'll say, "Hey, we're capped at 60% loan to value because otherwise the debt service coverage ratio is too low." Um, they also ask you what your FICO is, and the combination of those three things will come up with a price. It's a little bit of an iterative process, right? Like that's like a right word, um, because if the value goes down, the debt service coverage goes up, and then pricing comes down. So in the pricing matrix, you have to you decide, hey, I want 55% loan to value. You got to hold one of those things constant to get the price. Um, but anyway, but then that gives you the quote, and then they'll ask you for the operating agreement, verify your insurance, um, and go through the appraisal, make sure that there's no flags in there, that the property is in C4 condition or better, and and then send it to closing. But the underwrite's quick, like as a result, that none of that is too hard, not too onerous for a real estate investor. And so the closing time frames are, a couple weeks.
So in essence, there's a few factors that determine the loan amount, right? So appraisal is number one, right? So that establishes the ceiling for how much loan you can grab. Then everything else is pretty much standard, right? So the lease is the second part, right? So how much am I or can I collect in that neighborhood or for that property? And everything else is pretty standard, right? Taxes, insurance, that doesn't change the amount of money I can withdraw from the property.
Yep.
Okay, so we established that the lease amount or rental amount and the appraisal are two most important things that the lender should worry about. So let's touch on what happened with Baltimore City properties, right? So let's tell the audience the story if they are hearing that for the first time. It's the fraud that I haven't heard about for a while, and I was actually surprised that that worked.
Yeah, very much so. I so Dominion Financial is a mortgage originator. We originate RTL and DSCR loans nationwide. We also have a sister company that is Dominion Properties, not sure, that buys real estate in Baltimore City. We have offices there. We buy about 100 houses a year. We have a rental portfolio. We'll flip houses to homeowners, fix them up and then sell them to homeowners, and we'll fix them up and keep them in our rental portfolio. So we have like a presence as a real estate investor in Baltimore City. And this situation hit my radar, uh, really actually because I started to see some foreclosures come through at the courthouse steps because we're down there as a buyer, as a potential buyer. And I saw, I get a spreadsheet each week and it's got the defendants because I'm curious, to see who's getting foreclosed on. And I noticed the same LLCs were popping up over and over again. And just nerded out and was doing some research on like, who is this? Why have I, why don't I know these LLCs? And discovered that uh, couple individuals own hundreds of properties in Baltimore City and had acquired them over the course of the past 3-ish years. I never heard of them before. So it was a surprise to me. And they were all getting foreclosed on. So I did a little bit of research just because I was curious as to what was going on in my backyard. And then a couple weeks later, I started getting phone calls from some of our counterparties that we sell DSCR loans to, inquiring about certain guarantors. And uh, I was like, "Yeah, I'm aware of that situation." And they were like, "Well, yeah, all the loans are going bad, and there's some concern that it's fraud." And so then I just nerded out and did as deep of a dive as I could on trying to figure out like what the connections were here. What is this like? What does this map look like of where these properties are? And it was eyebrow raising when I saw and I keep seeing foreclosures every week, more and more foreclosures from these entities. And it was eyebrow raising because as someone who just happens to know the Baltimore City values, I knew those blocks, and I'd see a $170,000 statement of debt on a property, which infers minimally a $200,000 appraisal, $210,000 appraisal. And I just knew that block has never been worth more than $120,000. Like it's just, if that's where it got. And so that there was a $170,000 statement of debt on this $120,000 block is very eyebrow raising. Right. Um, And so, what the public record research uncovered was about I found about 500. I've heard rumors that it's more than that, but I have found 500
Just in Baltimore City or nationwide?
just in Baltimore City. Just in Baltimore City. So I found 500 mortgage origination transactions, and in my personal opinion, all of which looked like the values were too high. Lower end areas of the city that, that in my experience are worth 120,000 dollars, with all of which had $160,000 plus statements of debt. So I immediately assumed appraisal fraud, right? Just because that had to be a component of what was going on here, because it didn't make any sense to me that the values could appraise for that, for those levels, right? And that's like a necessary component here. Um, I was very fortunate as an originator that we didn't actually have any exposure to the situation. Um, I never even got an application from any of the people who involved. So hey, maybe they knew us by reputation and that we'd get caught. Maybe I just got lucky. Probably I just got lucky. But anyway, so what the public record research uncovered was that there were a couple different purchasers and a couple different sellers doing a lot of business together. And all of those transactions, values looked high to me. Um, and as I've later discovered, and it turns out today, all of those loans are non-performing at this point in time and in various stages of foreclosure. Uh, and then, and then Wall Street started calling and saying like, "Hey, what's going on with this situation?" And everyone's trying to figure out like what happened. Um, so I'll pause real quick. I got some more details, of course, but that's kind of that was the gist of the situation. And so at this point, there's about 500 plus NPLs that are working their way through the process right now in Baltimore City.
Okay, so Jack, let me off. I have too many questions. So let's see. Is there a certain? Do we know the individuals behind the LLC?
Yeah, I'm gonna leave names out of it just cause, but
Yeah.
they've been like widely published within the mortgage and space, particularly the DSCR loan originators. Folks have every mortgage originator has, or sorry, mortgage loan purchaser has a set of folks that they prefer not to do business with, and they say, "Hey,
Like
what?
blacklist?
Hi,
Yeah.
yeah." And so these folks showed up on everyone's list like in the same week. So the names have certainly gotten around.
Wow.
Um, and they're one of the things that was remarkable about this situation was that they were all purchase transactions, right? Like you expect mortgage fraud in a cash out refi, right? A
Sure.
weak underwriter and an appraiser on the take can spell cash out refi mortgage fraud, right? That's what you expect. These were all purchase transactions, though. So, you know, there's a presumption of arm's length, by appraisers, by originators when you have a purchase transaction. Everyone's guards down a little bit more, right? Um, and I got my hands on a couple of the appraisals. Uh, they don't look fraudulent, right? And I think
Standard 1004 or small family appraisal, and yeah.
yeah, comps are point 0.3 miles away, point 0.4 miles away, like nothing eyebrow raising. The thing is, what one of the things they exploited though is a a fact about Baltimore City and frankly 50 other major American cities is that point 0.4 miles can be quite a different place, from the
Sure.
subject property to point 0.4 miles away. So the appraisal is FIREA compliant, looks FIREA compliant. There's nothing, specifically, the appraiser just used his discretion as the appraisal guidelines allow to pick comps. And this appraiser just happened to pick comps that were in a materially different quality of housing market that happen to be point 0.4 miles away, which you can have in dense urban areas like Baltimore City. Um, and so, one of the other remarkable things about this case is that it wasn't one originator, it was 15 different originators. So that's kind of like, that's really eyebrow raising. It's concerning because it wasn't as if it was just one weak underwriter and one appraiser on the take. It was 15 different originators. They got, it takes six things to make a plane crash. Well, they exploited six different things with nefarious intent and then took it around town to hit up like everybody. And so, it's concerning from the perspective of it's isn't that kind of like the proof isn't that kind of proof of systemic risk that you can take the same, game plan and go to 15 different places and achieve a nefarious intent, um, achieve a nefarious outcome. So that's one of the reasons I think that it's become as talked about as it has, because it does, I think, in my opinion, highlight some weaknesses that remain in the system, some departures from the intent of Dodd Frank and the practice of Dodd Frank guidelines, as they are exercised in today's market. Um, and Wall Street's response was to so far was to many purchasers decided, hey, we're just not buying in Baltimore City right now. We're not going to buy
Well,
in.
it's a terrible strategy. It's not the right way to approach this. But one thing that I wanted to pick your brain on, if you can share with me outside of this podcast the LLC names, I'd love to use my firm to go nationwide and research all the properties that they might own. Now, coming back to actual scheme of how it happened, I would imagine you need a lot of money and you really need to know the neighborhoods in the urban areas to go and acquire, right? So the way you describe the fraud is, let's say I have, and we'll talk about how much money you need per city to go and execute that scheme. But let's say that I have a blank check, I would go and buy the properties that are in the really poor neighborhoods, let's say for $10,000, $20,000, right? With the Alex LLC, I would sell to Jack LLC for triple amount and get the loan, which is slightly, say, 80% loan to value. Um, Now I have issues in proving that my rental income would be enough to justify the loan, right? So that's still, I still don't understand how is that possible on the scheme. And am I describing things correctly? Yeah.
Yeah, absolutely. Yeah. And Baltimore happens to be a place, again, like many other American cities, where the DSCRs are never the constraint in Baltimore. The rent to property ratio is very high. So it's a very yieldy market from an investor's perspective. Now, actually collecting that rent is easier said than done, right? But on paper, it underwrites well, right? The credit quality of of the tenant profile there is very challenged. But on paper, it looks like you should make a bunch of money. And in this case, there was a combination of the properties actually were rented. I doubt much went into the tenant screening criteria. It was more like buy a property for 70, put 20 grand into it, put a body in at 1,300 bucks a month rent, sell it to somebody for 200 and get a DSCR loan at 160. That was the business plan here. And so to your question is like, what you would need to execute this. So you need someone local boots on the ground who knows the local real estate market. Of the folks involved in this scheme, they had that. There were some locals involved. So some of the folks were out of town. Some of the folks were out of town investors, quote unquote. Some of the folks were local operators, and so the local operator would find a property, fix it up a little bit, put a body in there as a tenant, so they could present a lease to the underwriters, and then sell it. And you could get a hard money loan to do that, right? You can get RTL loans to do that. So you don't need a whole lot of capital to get that going to do the first one, and then sell it to your buddy, right? Alex LLC sells it to Jack LLC, and then 160,000 in new money comes in. Jack LLC wires his 20% down payment. So you need to start off with a little startup capital, right? You need your down payment on that first deal. Wire that to the title company so that everything looks like a normal 80% LTC purchase transaction. And then 160 grand of new money comes in, right? And we were into the property for 100, say. Um, and so now we got 60 grand in new proceeds that went to the seller, LLC, Alex LLC. So you're holding 160 grand in new proceeds. Uh, I'm out 40 grand of my down payment, but we've got 60 grand of brand new money that comes into the situation, that comes into the scenario. And so my theory of the case is that this is just my theory of the case, is that money then moved back under the table to reimburse the buyer for his down payment. And we got 60 and pay off the old hard money lender. And we got 60 grand in new proceeds, right? So with 40 grand down payment of operating capital, we've created a $60,000, net, new cash flow that came into the, of new money that came into the system. Use those proceeds, do it, do two, you know, use the proceeds from doing two of them and do four. Use the new proceeds from four and do eight, and just keep recycling that through.
Is that what happened, or somebody had enough money to actually execute on 500 properties in Baltimore City, right? It's a significant amount for it
It,
to just not only acquire 500 properties or more, but also go through the foreclosure process, which is probably a year or so, right? So we're kind of late to the game detecting this fraud scheme. It's
it was on no one's radar. Yeah.
okay,
Yeah.
interesting. Um, so again, was it somebody with a big wallet, or it's using your strategy of one at a time and then multiplying the properties as you go?
Yeah, that's the question, right? So, like, the other theory of the case, right? My theory of the case was the cash flow model that I just described. The other theory of the case is that this was not fraud, that someone came down from New York to Baltimore and decided to invest in Baltimore and found local operators that were selling him properties, and he decided that he was paying $200,000 on blocks that had never seen comps for above 120 before, and he's just a really rich idiot. A guy came with 20 million bucks of equity to town and bought 500 properties in Baltimore's worst neighborhoods for twice as much as they're worth, and he's just dumb. And then his property manager screwed him and didn't and mismanaged the properties, and then and he's just an innocent victim here, and of local operators who took advantage of him, and then a property manager who mismanaged the property. That is the theory of the case that is being presented in the bankruptcy filings. I don't think it's true. I personally think it's a crock of shit, and that this was that there was a different cash flow model. Only somebody, the way to figure out the answer is discovery, is to get your hands, is someone who has standing needs to bring a case and compel discovery on the bank statements of the buyer entities and the seller entities in this case. And if there was cash flow, right, and if you can see the flow of funds moving back underneath the table post closing, then my theory is correct. If that is not the case, then you'll see, someone who came to town with 20 million bucks and just sent in a bunch of down payments, and that's what the bank statements will look like. It's going to be one of those two.
So you said somebody needs to bring the case forward. Now, who suffered the loss? Who is that somebody that has the right to step forward and say, "Hey, listen, here's my loss, and that's why I have a right and a standing to go and sue those LLCs."
Right. So the loan originators originated the loans, and then sold them. Some were table funded by wholesale lenders. Some were originated by originators and then sold in the secondary market. Some of the loans ended up on insurance company balance sheets. Some ended up in securitizations. There is what is working its way out right now is the reshuffling of risk here, right? There's been allegations of fraud. There has not been a civil fraud conviction or civil fraud judgment. And so there is a conversation. There are many conversations happening between the securitization shops and insurance companies that ended up holding this paper and those originators, and conversations around whether, whether if in many MLPAs and many master loan purchase agreements, there is an allocation of risk to the originator at the time of for sorry, allocation of risk to the originator for fraud as of the time of origination. So regardless of knowledge, right? There's no knowledge qualifier in the MLPA that says that hey, if there was fraud, it's on the originator. And so a number of loans I know are being put back to the originators on that basis. I'm also aware of other situations where that didn't happen because maybe the MLPA language was different. Maybe it was just a business decision. I couldn't tell you why, honestly. But in some cases, the originators are getting the bag handed back to them. In some other cases, the ultimate money, the institutional investors are holding the bag on this one. And I think that, we have not run out a statute of limitations yet. And so there is a couple bankruptcy filings that have happened on the entity levels, and I'm very curious to see how the next 12 months plays out in terms of, if and when actions are brought, as it relates to fraud. Is anyone going to try to actually, in court, say it was fraud? So far, that hasn't happened. Those filings have not yet happened.
Interesting. Now, for folks that are listening to us, remember that title policy that was issued on those loans does not cover for fraud, right? There's a small language on the bottom of the title policy typically says that it's not responsible for chain of title defects, which in this case, that's exactly what happened, chain of title defects pointing to the fraud. Just a final element on your story. Uh, the fraud involved appraisers, right?
Mhm.
That's something we didn't touch, and maybe originators that are looking at this market or any other market should really check for some of the appraiser fraud, and that was a unique way on how appraisers operated in that scheme. So, can you share with us on on what you found?
Yeah, yeah. So yeah, as you said, like you necessarily need the appraiser to be finding these values, right? Again, one theory of the case is that the appraiser just screwed up and picked comps that were too high, and it's just run of the mill incompetence. Um, I think that there's such so much circumstantial evidence. I don't buy it. Right? That's my personal opinion. It is remarkable in this case that there were only a few appraisers used. And in a post Dodd-Frank world where AMCs are supposed to be that arm's length, keeping grooves of appraisers and lenders and borrowers working together, they're supposed to be spreading out that relationship so that these grooves can't form. Um, it's mathematically, it shouldn't have happened. Mathematically, it's impossible, right? With if the AMCs, if the appraisal management companies are operating used based off of the intent of the Dodd Frank, rules, this shouldn't have happened. It shouldn't have been allowed to have happened. Um, that said, how did it happen? Uh, Let me start with I don't know. Like, I don't have any firsthand knowledge. I haven't seen any primary documents, showing email correspondence between the appraisers and anybody. So the real answer is I don't know. I guess my strong suspicion is that the AMCs were, my strong suspicion is that brokers may have been involved to get the appraisals ordered. And the broker relationship with the AMC was cozy, maybe cozier than it should have been. And uh, and the appraisals were ordered, kind of the way then AMC will come to an originator and say, "Hey, I want to earn your business," right? And they'll say, "Hey, you're a local lender in Baltimore. You know who the good appraisers and the bad appraisers are." Nod, nod, wink, wink. Of course, I can't let you pick your appraiser, but you can help me build a panel, and we can use that panel for you. And so as a morally unscrupulous originator, will pick my 10 buddies that I know will come in, pretty good, come in aggressive or whatever I want, right? Whatever flavor I'm looking for. And I'll get my 10 friendly names on that list. So that's how I stack the deck, right? Is I've built my own panel. And we're still within the four letters of Dodd Frank, because the AMC is then going to divide up, is going to, put out for bid that appraisal work. And those 10 folks are all going to bid on it. So that's how you stack the deck, is it's 10 friendly folks. The way you deal yourself aces is through some kind of signaling, whether it's price signaling or turnaround time signaling. Uh, you say, you tell Joe, who you want to get the assignment, hey, last time when we ordered appraisals, everyone was, $520 or above. Come in a little below that. or use a specific number. Like in this case, it turned out that they were using $444 was the bid. So the AMC put it out to bid, right, on a blind, and then presented the quotes on a blind basis. But either the broker or the borrower who then can choose which one he wants knew that $444 was his buddy. And so you could also use turnaround time signaling, like make it 9 business days. Something unique, to signal that that's Jeff. Um, and yeah, that was something that happened in this case, was that there was price signaling being used via the AMC process, and as a result, the same appraiser was chosen over and over and over and over again, and those numbers always came back right. How if the appraiser was compensated, was did he actually get a check, or was this just a big account and there was a nod, wink, wink? I don't know. Yeah, I have no firsthand knowledge of any of that, but it's just in my opinion, mathematically impossible for there not to have been something going on there akin to what I just described.
Do you think that's going to be an Securities and Exchange Commission case? Because somebody on the federal level should be investigating that. It
Could be.
seems like too many things going on, right? Sounds like a Ponzi scheme, fraud scheme, and if one of my firms will discover it's going on in other cities, that should be really lifted to the federal judge.
Yeah.
Interesting. Um, so I know we covered all the things that happen here. Too many things to digest. But let's talk about the solutions in the next 20 minutes or so. And let's start with the obvious ones. Um, we just talked about the appraisers and some of the friendlies. I would assume that the originators, and you said there were 15 originators involved, they would automatically put those AMCs and appraisers in the blacklist. Unfortunately, the blacklist of appraisers are not national. They're per lender. Is that accurate?
There are DSCR loan purchasers that maintain their own blacklists, and there is a lot of commonality between those blacklists. And all the folks involved in this particular case are now on that blacklist, but were not until 2 months ago. So all the 500 transactions happened totally under the radar. It was not until the loans stopped performing that, and people started, and loan purchasers started looking into what happened here, did they realize, oh God, there's a pattern of the same appraisers, we need to add these guys to the blacklist. So the horse was already out of the barn by the time these folks got on the blacklist.
Yeah. So in my experience, some of the folks and originators we're working with, they have their own blacklists. It's completely,
Yeah.
separate, not combined. They track it separately, and every time we receive a guidelines to underwrite a loan and due diligence, they give us their own blacklist. Say, do a comparison in that blacklist to make sure that none of those appraisers jump out at us. So that's interesting. That's probably number one thing that I would recommend to somebody like a MBA, to pick up the council on blacklisting AMCs and appraisers, right? Because that would solve some of those issues, I guess. But let's talk about solutions. Do you see any obvious solutions? And I'll pitch in with what I've seen and what some of my clients, by the way, suffered those losses. Some of my clients in the capital markets are now scrambling on all the DSCR loans they purchased, and some of them discovered that what you're describing, those loans end up on their books, and they're really looking for solutions, and they're asking us to design products. So let's brainstorm together. That's an interesting here.
Yeah, sure. I mean, one of the other, I think, important details is that in all of these loan files, with loans destined for securitization, for rated securitization, the rating agencies want to see a secondary valuation in all these files, and all of these files had secondary valuations that which was essentially a desktop review of the appraisal, and in all these files there is a statement of, an opinion statement that says that there is no variance between the appraised value and our opinion of value. And they got it wrong 500 times, and they got it wrong by like 80%, right? Like it's not great. It shows that the secondary valuation product has room for improvement. I'll put it that way. Because if you're a loan purchaser, you're the rating agency, that secondary evaluation is a nice warm blanket. You're like, right, I had a set of independent eyes that looked at this appraisal and said, yeah, no, everything looks good here. Now, part of that is that dense urban areas like Baltimore but also like Philly and Newark and Detroit and New Orleans and Atlanta and 50 other cities are hard to do appraisals in, right? Like the appraisal guidelines allow for a significant amount of appraiser discretion in terms of choosing comps. And they can just choose the comps that they perceive to be the most appropriate ones. And they don't have to explain why they didn't use, if there's a comp on the block, they don't have to explain themselves as to why they didn't use that comp on the block, right? They can just go point 4 miles and say, because because I'm an appraiser, because I'm certified, I thought that that was more appropriate. And that judgment is very difficult to question and very different. And if it has been co-opted for nefarious intent, is very difficult to detect. One of the things that we do as an originator is to do internal appraisal reviews on every DSCR loan that we originate. It's expensive to do that, right? I literally have a team of underwriters who are basically in-house appraisers who are, they get an address and they pull their own comps and they come up with a number. And then they open up the appraisal and see what that number was, right? Like it's the idea of taking the appraisal and saying, does it look right, is not as good as come up with a number and then see if it's the same number as these guys, right? And so really that approach I think is necessary in order to do a real check on if you think the appraiser got it right or not, and then reconcile the results, right? And if there's a variance of greater than, we use 10%, there's a variance of greater than 10% between those two opinions of value, that needs to get escalated and someone needs to make a judgment call and actually dig in on this thing. Because above 10%, someone got it wrong. Someone's just wrong, right? Like, within, less than 10%, 5% difference in opinion of value. Yeah, whatever. When someone says it's worth 200 and someone else says it's worth 270, someone's just wrong. And so we do that. And I think that it should become more, I think it'll probably become more widely industry practice to do that. But that'll be at the originator level, right? You could,
Would Zillow get it right if you use Zillow Scraper, or Zillow would still get it wrong because it sees the prior transactions?
yeah, I don't love that. And also, like, I mean, well, and in this case, Zillow would have seen all of those other transactions, which are actually not arm's length in the first place, right? But it doesn't know. Um, using MLS comps where you can see the interior pictures, this is particularly difficult in non-disclosure states, right? Like that, this becomes really hard in non-disclosure states. Um, but in my opinion, doing that independent valuation is an appropriate risk management exercise. It's expensive though, right? So someone's got to eat that cost. But I think if I could, do that versus a secondary valuation versus a desktop review of the existing appraisal, I don't really put a whole lot of stock in the secondary valuations. I like the independent approach.
Let's go through the list that I brainstorm on, and see if you agree with me. So, an expensive approach would be a chain of title deed research to figure out the sales price from
Yeah.
LLC to LLC. So that product we already offer, right? That's a little bit expensive in the underwriting world because you really are pulling the documents, sending people nationwide to do that. But this will tell you that within 2 or 3 year cycle there was a sale which was much higher, right?
Yeah.
Well, let's see, tracking sales transaction, MLS or any other data source. I mean, we subscribe to probably four in the pro title where you do the same, right? So it's a tracking of sales transactions within a certain period, right? So putting the threshold of, let's say, 10 years, I don't know, 5 years, and seeing if this is something out of the blue, right? If it's more than double, that's the red flag, right? Uh, common ownership to the LLCs, right? So while you're doing the Secretary of State research on who LLCs are, buyer and seller, if you track that the member structure is the same from buyer to seller, that's a red flag as well, right? I'm not sure if that was the case for the fraud case in Baltimore.
It wasn't, but if you had done that and if you had well, you'd have to expand it a little bit to have detected it in this case to actually say, "Hey, these people are doing business together. Have they done business together before? Let's look for these LLCs or other LLCs that these members are associated with and see, and look for patterns of business activity. Or is this just like a truly arm's length? I just met this guy and sold him a house. Or, is this the 60th house that I've sold him? In which case, then you dig into the like, then is it really arm's length at that point? We're doing a
Yeah,
lot
so
of business together.
it's either too much activity or too little activity, right? So
Yeah,
one of the things is in underwriting, right? It's an experience in the prior projects, right? So you really have to have a track record of somebody walking into Baltimore City and starting to buy this stuff
yeah,
while having no experience, right? So if I would be doing the statewide name search for this LLC, I want to see that that LLC was in business for some time. They have expertise. They bought or sold for a reasonable amount. So there's a history involved, and there's some sort of analytics that I would expect, the underwriter to look at, or the buyer present. So
yeah.
that's an interesting one. I have to think about how to design the product for that.
Yeah, right, exactly. Someone who comes on the scene out of the blue, right? Like it's weird for someone to go from no real estate experience or no prior transactions to buying 80 houses a year. That doesn't happen. That's no one has that story. No one goes that big that fast. So yeah, like looking for like bell curves. Like if we could like create this is we're getting a little nerdy here, but like creating bell curves of like typical activity of like this
Yeah.
is what patterns of activity usually look like for like people who are in the market for a while, and then identifying what the edges are of that bell curve and flagging those edges.
Yeah, I agree. I mean, I was an investor myself prior to 2007. I bought the first property. I figured out how everything works. Second property, third property, then apartment complex. So I had that bell curve.
Right.
And I expect anybody who is investing in real estate, they would go through the same thing. But
Yeah.
yeah, so we got to talk about it. Maybe there's something there. Um, Proof of funds and deposits and money flow, right? So that's a different view of things, right? So if you are describing the fraud scheme where you get the money out of the first property, you flow it to a different LLC and different bank account, I wonder if there's a way to track that and build some sort of a mathematical formula to also figure out if there's a pattern, right?
Yeah.
It's not a part of the underwriting right now, but maybe there's something there to on the regular transaction, you see the proof of gift, proof of funds, right? You question every deposit. I don't know if that's the underwriting technique for the DSCR loans. Probably not.
Not, not standard, not required.
Yeah,
Put it
yeah,
that way,
yeah,
not required. One of the I was fortunate to get my hands on a couple bank statements, and because I was curious, like, hey, are the title companies in on this, right? Which is sometimes often the case in fraud situations. I only got a couple months of a couple bank accounts, um, but I was able to see that the wires were going to the title companies, um, so like from the like on a normal amount, right? Like the wires were actually going there. It wasn't as if the title company lied and said that the down payment came in and it never came in. Like they know a wire for 20% plus closing costs came in to this title company, and then another one, and then another one. Um, in that statement that I was reviewing, there was a transfer at the beginning of the month from another of that borrower's LLCs. So my suspicion, again, this is just my suspicion. My suspicion is that the money they were smart enough to not send the money back to the same LLC at least, but may have used a sister LLC to funnel it so that you couldn't, so that they knew that the LLC, sorry, the bank statements that they did have to provide would only, you'd show a related party you'd see related party transactions at the beginning of the month and then outflows during the course of the month. But unless you were really diligent, and there's nothing in the guidelines that requires anyone to be this diligent, but if you were being really diligent, you'd say, hey, that's a big related party transaction at the beginning of the month. I need to see those statements too. It would annoy a lot of borrowers if you used that level of diligence, but I think that there's a probability in this case that that extra step would have uh, would have shown, the real flow of funds and what was going on, and may have been a flag, but also no one was really looking. So
Do you think bank abated the the scheme? Because the money flow should be questioned by a bank through their guidelines on the Ponzi schemes. So that's an idea that banks should be worried if there's a common bank used. You should really take a look at your guidelines. But let's skip that because that's a completely separate conversation. Cross collateralized loans. So that's another thing, right? That's a red flag. For some of the properties that I saw, um, for my clients that acquired those 500 loans, um, some of them were cross collateralized, which is, three or four or five properties were used to get single loan, which makes it more difficult to sort of combine the appraisals and figure out if the value of the loan makes sense. But
oh,
yeah, I think that's another red flag. So um, we talked about blacklist of the appraisers.
the the AMC system is, I mean, if originate, panels, right? Panels are allowed. I think it's hard to defend, um,
Yeah.
but they are still allowed.
Um, Title research on to underwrite the ACR loan should go outside of the LLCs, right? So that's where during the origination process, right? Even well, the purchase should be a 30-year research on title, right? So you got to have a 30-year chain that should have been visible during the origination of the loan on the purchase, right? So I don't understand why nothing was questioned by at
Yeah,
least
it
title
is.
agents and title companies.
Yeah, it is, just, yeah, using the kind of the common sense of like, um, the seller bought a property for 70 grand, spent some money fixing it up, and then sold it for 200. And he did that a lot of times. Like, is this guy that well, one, what you don't know though is how much work was put into the property, right? Like that's not
Sure.
recorded anyway. So if the answer was, yeah, but he put 80 grand into the house, well, then that's a reasonable margin, profit margin. I think that if you look at the appraisal pictures on these, though, and in these, like, you don't see a house that had 80 grand put into it. You see a house that was like painted. Um, so uh, it's a little bit of a red flag. Like the seller made a ton of money on this, right? The seller's making $90,000 spreads on $90,000 properties. That's an eyebrow raiser, and everybody just didn't pay attention. No one raised their hand on the idea that this guy is murdering it, making money. The seller's making a ton of money on all these transactions.
It sounds like we need a property condition report as a part of the closing. That should have been done, right? So on the on the
There's
regular
interior
transaction,
pictures. Yeah, there's interior pictures in the appraisal.
okay, that's
I
interesting.
mean, they're not great, right? It's like 10 pictures. You get like 10 pictures of little thumbnails, They're not it's not awesome, but
People don't pay attention to that. It's a checkbox for them. Okay, I made the internal external appraisal and I have a pictures and it's great. That's
yeah.
interesting. So maybe with the new AI technologies, as we spoke about, there's some sort of a detection method on the pictures, or no holes in the roof and the fence is straight and there's no junk lying around, right? So maybe tracking some of the insurance claims data. Maybe there was a flood, fire inside the house. So all of the property condition, data points that can be generated from different sources can be cross compared, and then you make a final decision, or at least a human eyes would look at the property and say, you know, there's a large sale, so I'm expecting to see some sort of a permits taken out, right? So
Yeah.
track for the permits in in the municipality and see if there was a new roof or there was a new sink or there was a new wall or electricity. So maybe an easy
That's a good
way
one.
to,
I
yeah,
like
to
that one
check.
there.
Yeah,
Yeah, if there's a if the seller, if the you know, the seller in this transaction, of course, we're talking about purchase transactions right now.
yeah, yeah.
Yeah, right. Well, even in the cash out, even in a refi, actually, you know what? Even on a refi, like borrower buys a property for a number and then is refining it for, you pick your algorithm, design your own algorithm for, 100% more or at least $80,000 more. One would expect to see permits in that
Yes.
situation. You've either got a lot of unpermitted work or an eyebrow raise as to whether that much value is actually added without permits.
That makes sense. And by the way, we do permits. So one of my products in the pro title land is doing unrecorded municipal searches. So taking a look at water, sewer, gas, utilities, permits, code enforcement liens, so things like that. Permits would definitely be a flag that, hey, there was something done to the property, at least initially, or the intent was there. So interesting. We just came up with a new suggestion.
Good one.
Hmm.
That's good.
Wow. Yeah. Good. All right. So just to wrap things up, again, that was super valuable. And once we publish that to YouTube channel, I'll send it to some of my clients just to see if they have any ideas based on our discussion. And Jack, your wealth of knowledge. I mean, the fact that you started to do things yourself to figure out, okay, let me investigate this and bring it up. That's amazing, and
Just
I thank you
just a
for that.
nerd. Yeah, just a nerd.
I'm the same way. I get my even though I'm a CEO of 3 companies, I get my hands dirty. I wanna know why, how, who, how do I find it? How do I not make this mistake?
Yeah.
We're trying to learn on somebody else's mistake, so I guess we're smart enough to do that.
Yeah, and I think that the issues of risk management are becoming much more prevalent in a more difficult to operate environment. Liquidity is more difficult for real estate investors right now because property values are not going up like they have been, and so you're going to see more people who have cash flow stress, and then as a result of that cash flow stress, you're going to see more people look to color outside the lines. So I think that this is something that has already started to happen. This is a canary in the coal mine situation, I think, but I think that the theme of risk management is going to be, a very important thing for running businesses for the foreseeable future in this space.
Agreed. Again, check. Thanks so much for coming to the podcast.
Oh, my pleasure. Thank you, Alex. Yeah, really enjoyed it.
Absolutely. Take care.